you can't just buy whatever people are not buying. I mean, there's often a good reason why other people are not buying it. You can't just knee jerk contrarian, right? You can't just always be whatever the crowd's not. So he says value investing at its core is the marriage of a contrarian streak and a calculator, meaning that you can't just be different than the crowd. You have to be different, and the actual thesis has to make sense. If you're investing in the horse and buggy industry, 100 years ago, you're gonna have a bad time, right? Even if it's past its prime, it looks cheap. It's a value trap. If you run the numbers, you're gonna be probably not want to go there, right? So basically, it's the combination of leaning to where people are not, but also making sure that the areas you're leading into do make fundamental sense going forward.
Whether the U.S. economy will get the much-awaited soft landing or severe recession is still very much up for debate. Top investment banks, executives of large corporations, and leading economists and market analysts are certain that the economy is either already in recession or definitely heading for one. On the other hand, top government officials like Treasury Secretary Janet Yellen continue to insist that a soft landing is still very much possible. Regardless of what lies ahead for the economy, a well-tailored investment portfolio might help you avoid the worst and stay afloat. During a recent webinar with YCharts, popular macro analyst Lyn Alden discussed the dangers of following the crowd when making investment decisions during such periods of economic uncertainty. Alden, the founder of Lyn Alden Investment Strategy, explained that following a contrarian strategy might just be the way to avoid the macro headwinds expected to hit in 2023 and possibly continue for the rest of the decade. However, she added that a contrarian strategy that is only done to avoid following the crowd might bring more harm than good. During the webinar, Alden also discussed the general psychology of investors during downturns. She explained that many investors consistently take money out of the funds that have recently underperformed to chase successes that have already occurred. According to the popular macro analysts, this is why most people constantly invest in market tops and remove money in market bottoms. We will now bring you Lyn Alden's webinar as she shares several useful tips and strategies for making brilliant investment decisions amidst all the chaos and uncertainties. Please watch the video to the end, hit the like button, and subscribe to the channel for more videos like this. Also, ensure you drop your comments and observations in the comments section below. Everything helps with the YouTube algorithm so we can continue to bring you these videos. Thanks and enjoy the video. Alden began the webinar by discussing the dangers of following the crowd when making investment decisions, as well as some important things to note before choosing a contrarian strategy.
Looking at this chart, the one before it, basically there's a basic problem that a lot of investors face with investing, which is that if they were just to set up a relatively diversified portfolio and leave it, they'd probably do pretty well over the very long term. But there's a lot of urge that people have to tweak it, right? They want to chase what has recently done well. If say a certain stock market just keeps going up and they're not overweight into it, for example, they feel like, well, why do I own these other things? They're not going anywhere in like 3 years or 5 years or whatever the time frame may be. And so by the end of that period, towards the later stages, they often overweight that thing that already did quite well and is now a very crowded trade, more highly valued. A lot of global capital is already kind of stuffed into it. And then that sets the stage for actually a period of underperformance, most likely, not every time, but most likely, statistically speaking, over the next 3, 5, 10 years, whatever the time frame may be. And so by chasing periods of past returns and getting out of things that are cheap and going into things that are expensive, they kind of systematically underperform a relatively passive diversified benchmark, which is, that's pretty catastrophic over a 40-year let's call it investing career, right? That can lead to considerably less retirement savings by the time you're done. And then going back to the slide we had after that, basically that on a quarter by quarter basis, and also if we had this similar type of quilt up for like a 1 year return, for example, it would look very similar, which is that any given year you can have very different assets that are doing well or doing poorly, and then those tend to do quite, the ones that did well in a given period tend to do very poorly after that. They're often, filled with euphoria. They're overvalued relative to their fundamentals, and so they tend to fall off in the quarters and years ahead. And so by chasing those past returns, investors more often than not hurt themselves. And so basically, the kind of the two ways to counter that are either to stick with a very rules-based, diversified, just firm approach, or to lean in the opposite way, to basically lean into things that are maybe haven't done well for a 3 to 5 year period, but that that are showing signs that kind of transition, some of either the macro factors or the valuations or the fund flows may be gradually turning, and that there's maybe an opportunity to outperform by kind of going against the crowd. Basically, when people are euphoric about a certain asset class or certain types of equities, a contrarian investor kind of their knee-jerk thing is like, you're not necessarily saying it's going to be a bad investment, but you're suddenly becoming more cautious, rational, and concerned about it. And maybe, for example, you have a valuation framework or a fund flow framework or something that gives you actually quantifiable cause for concern. On the other hand, when people are, afraid, there's a recession, there's some sort of bad market news, basically you're saying, okay, well, there might be opportunity here. If this whole industry sold off, for example, are there some babies that were thrown out with the bathwater? And can I go in here and see, okay, what is actually undervalued? What is actually maybe not impacted as negatively as people think? How much, when the emotion blows over, what here is actually in pretty good shape? And you kind of lean into that.
The effectiveness of a proper contrarian strategy can be observed in the cryptocurrency industry. In 2021, when crypto assets were peaking, everyone wanted to buy Bitcoin and Ether. Now that these assets are much more discounted, the hype has waned, and most investors seem to be waiting for the next bull run before they buy again. But true crypto believers know that both the 2021 all-time highs and the current crypto asset prices are discounted prices for top cryptocurrencies like Bitcoin, Ether, Cardano, and others. Holding in the long term while keeping track of general developments as well as promising projects is certainly the best strategy to follow when investing in the cryptocurrency industry. Let's get back to Lyn Alden's iCharts webinar as she gives examples of asset classes that are currently undervalued, those that are undervalued, and how to effectively switch during this period of high economic uncertainties.
Yeah, and I just have an example here. I kind of like picked a handful of different asset classes, right? So you have technology, REITs, energy, precious metals, industrials, and financials. There's very different market conditions that might lead one of these to do better than the other. For example, technology stocks tend to be highly valued. They tend to prefer, they have long runways of expected future growth, especially if they're growth oriented technology. And so they generally prefer disinflationary environments with low interest rates because then there's very low cost of capital and you can afford to have like a big long runway of unprofitable growth or low profit margin growth ahead of you because you can look 10, 15, years in the future and let that compound. On the other hand, if you have a more inflationary environment with higher rates and higher cost of capital, then things like energy or financials often are doing better in that environment. And suddenly those technology stocks that are trading at 20 times sales when interest rates were zero suddenly look a lot less attractive when interest rates are 4 or 5%, for example. And this is a pattern that's repeated in history. I mean, in the late 60s, for example, growth stocks were very overvalued. And then when you got the inflationary 70s, those were absolutely killed for like a decade, and the value stocks that were kind of cheap to begin with did pretty well. And obviously anything commodity related generally had a pretty good decade. And so basically if you start with this kind of example pie, go to the next slide, if technology had this long stretch of disinflation and is now quite overvalued, and you start to see either macro conditions or valuations suggest otherwise, you might want to shift towards other things. Maybe you get in real estate, maybe energy, maybe financials, whatever the case may be. You get out of things that you view as overvalued and get into things that are undervalued. Now, that's obviously easier said than done. You're going against just the mindset of, it's hard to sell something that's done well to buy something that hasn't. You need an actual thesis for why that's likely to change. You don't want to just, cut your winners and double down on losers kind of systemically. You want to actually have a reason why you want to stick with them. And you have to be right about your thesis. But in general, people that are able to do this well are likely to at least do better than the average investor. And if they're good at it, can do better than the market potentially.
Yeah, and how do you handle this type of process when there's so much noise in the markets and the media is talking about what the Fed's doing every day, one way or the other, and talking about interest rates and how that impacts these sectors? How do you take out all that noise and have more of a systematic approach to this?
I think one is to be very specific about the time frames you care about. So, a trader might define their time frame as, weeks and a couple months, right? And they want to, get in and out to different things. An investor, right, might define their time frame as 5 years, right? They want an investment, they want to buy something, and they don't care what the price does. And some number of years in the future, let's call it 5, they want to sell it and have that have been like a good return. Or if it's still going strong, they can let it run until it doesn't make sense anymore, right? And so I think being very specific about your time frame lets you filter out noise that doesn't make sense while still looking for information that might either confirm or disprove your existing thesis. So basically, as the information comes in, your filter says, okay, does this matter on a multi-week basis if I'm a 5-year, value investor, or does this actually threaten the thesis of the investment itself, even over that 5-year time frame that I care about? And so I think that's one of the clearest ways to do that. And it's also one of the things where, retail investors have a lot of disadvantages compared to Wall Street investors, but one of the few advantages a retail investor has is flexibility over their time frame. So if you're a professional money manager, you're marked to market on a monthly or quarterly basis. You have a relatively short period of bad performance in a row, you're out. So you're kind of forced to chase trends. Whereas if you're managing your own money or your family's money, and basically, or you have other sort of like lockups or kind of discretionary time frame, then you have this source of arbitrage that you can do. You can make use of the fact that you can ignore a short-term time frame, for example, and focus on the longer-term time frame.
What are your predictions and outlook for the U.S. economy in 2023 and beyond, and what investment strategy are you employing to navigate what is ahead for the economy? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe, and turn on post notification for more enlightening videos featuring some of the greatest minds in the industry. Thanks for watching.